classical problem that we see, that companies focus too much on acquisition, focus too much on that new logo. Almost every dollar spent is focused on the sales team and maybe the marketing team, not enough on the customer success and the people that are responsible to retain and expand the existing client base.
My name's Mike Lander, and you're listening to Higgle, the B2B Sales Club podcast, where we bring you actionable insights about sales RFPs, negotiations, and difficult procurement discussions from sales leaders, brand leaders, and procurement leaders. Please subscribe to get updates when new episodes are released. Roee, thanks ever so much for joining me on Higgle, the B2B Sales Club podcast. It's great to have you.
Yeah, thanks for having me.
So, for the benefit of our guests, just introduce yourself. Who are you? What do you do? And something unusual about yourself.
Yeah, so my name is Roee Hartuv. I'm a revenue architect at Winning by Design. I started my career in sales. This is where I spent most of my career. But I would say 4 years ago, I transitioned into a go-to-market strategy consultant and joined Winning by Design. Today, I run the revenue architecture practice. We work with fantastic B2B recurring revenue businesses worldwide, mostly though from US, mostly SaaS companies, help them assess their go-to-market strategies and design the processes that fits to an efficient and sustainable growth strategy.
Brilliant. And something unusual about yourself?
Yeah, I had a career. I was a combat helicopter pilot. I don't know if you got that a lot, but that's...
I've never had that. A combat helicopter pilot.
Yeah. I did that for 8 years.
What did that teach you about leadership and human beings and stress? Just out of interest.
All of that. How to cope with stress. Prioritize, making split decisions. How to work in a team. All that. Of course.
Amazing. Wow. Amazing. The term revenue architect, just before we get into the questions, what does that mean? Because I've been around sales a lot, and that seems to be a new kind of recurring theme around LinkedIn and other places. Just help our listeners understand.
Fantastic. At Winning by Design, we believe that go-to-market strategies and processes need to be designed and planned according to according to scientific principles based on data. And we're trying to take some of the great things about architecture and use this term in order, let's build and design a revenue system, a revenue factory based on scientific principles and models and frameworks. And this is what we're...
Brilliant. And that really kind of for me, that definitely rings a bell. I've been talking to all of my clients for years about a sales and marketing engine. So in different terms, you need a system. Yeah. You need a repeatable system. You couldn't drive a car down the road that one day produces 400 brake horsepower and goes at 80 miles an hour. And the next day, you can't turn the engine on. And you're never sure which day you're going to face. It has to be a predictable way of generating new business.
When you think of it, most of the companies that are out there still are working based on gut feeling, right? So let's bring an expert. They have done this in the past, very successful in company A, company B. Replicate that and we'll hit success. But we believe that there's a better way of doing things. Let's look at what are we selling, to who are we selling. Let's build a strategy that is right for the company, for our buyers, and not based on whoever we're hiring and what their past experience was. And we believe that we can build that kind of systems, we call them revenue factories, based on frameworks and models and scientific frameworks and models.
Fascinating. So let's get into our questions, because I'm also conscious that you've got limited time. So what do you think's changed over the last 5 years in the SaaS tech market regarding valuation models, the obsession with pure top-line growth, and then also just follow that up with the current need for profitability? Because obviously what what used to be the word on the street was it's all about sales growth, profitability will come, but we need to get top line growth. So what do you think's changed in the last 5 years?
That's a fantastic question. So there was a pivotal moment, December of 2021. This is where Dropbox stocks plummeted 40% in a matter of 3 days.
Wow.
And that signaled the first event of our SaaS market crashing. Basically, there's no other way. Our market crashed. That was the first sign that happened. Over the course of 2022, we started to see all the major companies out there, sluggish sales, sluggish growth, and we all experienced that. So our market completely changed at that year, 2022. Up until then, it was, money was relatively cheap. Yeah. Everybody was buying from everybody. Corona was also a fuel there. Everybody was happy. Everybody was growing, and we all saw how successful companies with amazing valuations and exit happened before that.
Yep.
After that, our market completely changed. We
no
longer have IPOs.
Exactly, because the IPO market seems to have, I don't follow it very closely, but there doesn't seem to be as many tech IPOs as there used to be.
In the past year, like we're December of 24 right now, we had only 3 IPOs of SaaS companies.
Wow.
Only 3. In the good old days, it was around, I don't know exact numbers, but between 60 and 80 a year, 2020, 2021.
Okay.
There are no IPOs, and there's a bottleneck. Why? Because there are no IPOs. So VCs, the investors, private investors, are not getting their money back.
Yep.
And they cannot pull that money back into the ecosystem.
There's no liquidity.
So that's one part. And it all starts, by the way, with, it's not start, but one of the things is that the public market investors have signaled to the private market investor, hey, we're not going to buy or invest in companies that are no longer profitable.
Right.
Whatever type of companies that you want to go public, we will invest only if they are profitable or have a very quick turnaround time to becoming profitable. And that's what we're seeing. So there are, according to Deal Room, there are more than 1,200 private SaaS unicorns out there. Private SaaS unicorns, most of them are gearing up or based on the numbers in 2020 and 2021, they were supposed to go public. However, no IPOs, they're stuck there. We've got a bunch of companies that are going nowhere. So they're not doing an IPO. PEs are buying them, so we see a lot of acquisition from PEs, which is fantastic. But of course, how many companies can PEs invest and buy? There's a limited amount. We're talking about more than 1,200 companies that are waiting. Yeah. And of course, the big tech companies like Google and Salesforce and Amazon, they have a limit to what and how they can buy because the US regulation is not allowing them to consolidate the market, right? So Lina Khan and FTC, all that there is happening. So our market is stuck right now. Unless you're focused on AI.
Right.
And then it's normal even.
Exactly. The rules don't seem to apply.
Yeah.
No.
Exactly.
If you just want to buy a whole stack of NVIDIA GPUs, then there seems to be money out there to do that. But anyway, that's a separate topic. So what needs to change then? So on the grounds that IPOs aren't happening, and therefore liquidity events are fewer, and therefore private investors have got money tied up in SaaS companies that they either want to exit or they want to see the valuation premium come out the other end. What's going to happen? So what needs to happen to those SaaS tech companies? What's the kind of situation with profitability? Has the focus been more on growth, less on bottom line profits? Will that change? Is it possible to change given the expectations around growth? Because can you acquire customers at a cost-effective rate in a way which ensures that you do get bottom line profitability drop through.
I'll start off with the last point.
Yeah.
I'm not sure that a lot of these companies will be able to turn around and conduct business differently.
Well,
a lot of these companies will disappear.
As will their investors' money.
As the investors' money. It's already happening. We haven't heard about this, but down rounds are happening. And there's a limit because the model and how it works is that you as an investor, put your money in a company, and 7 years later, you're going to get 20x or 5x, whatever the model is, and whatever the company does, right? And that's not happening. So the companies that will be able to do that transition, it's all about becoming profitable. And when we saw those 3 companies that did do an IPO, OneStream being one of them, they're all at between that 300, 500 million ARR. And we know for a fact that other companies that are gearing up for an IPO are at those ranges, and they are profitable.
They are profitable, yeah.
Unlike in 2020, when you could have done an IPO without even being close or don't even have a roadmap to becoming profitable. Oh, yeah, that's something that will, not a problem. We have a lot of monies in the bank, and the IPO will give us much more money to burn. Yeah, it's no longer the game completely changed for us.
So now, what's different? What's different with those companies? How are they profitable, and yet the other in the 1200 bucket aren't?
Well, this is where, first of all, there are successful companies that were working with a different mindset and grew differently. So not grow at all costs. Let's pour money at our problems or at our growth in order to grow the company, but let's grow in a more sustainable, thoughtful way.
Yep.
And I think OneStream is a great example. I just studied their 10K in details. This is what they did. So systematically, years before they went IPO, they started to focus on profitability. So cutting down costs, not only looking at growing from new business, but also maintaining, retaining, and expanding their current customer base. So this is what these companies need to do.
Which is, I am quite old school, but it is good old-fashioned business. It's like, so you find a customer problem, and you find one ideally that's big and growing, and you solve that problem for them, and you solve it at a ratio that if they pay you $100,000, then they get $1 million in return somewhere at some point, and you can demonstrate that, and then you acquire those customers and you service them really well and you retain them, and then off the back of that, then you grow with them, and then they refer you to other clients, and then you acquire more clients. But it's a slower trajectory; it takes time.
That's a fantastic point. And I don't know if the VC model works in a slow trajectory. I'm not sure, because the VC's model business model is different than SaaS companies, right? Yeah. Their model, they're financial people. They take somebody else's money and promise that them in 5 to 7 years, they will return a 3x, a 5x, whatever it is that they're promising them. Right, that's their business model. So for them, the quickest turnaround time is the best and minimum risk. And until recently, companies' valuation was all about growth rate. It's basically it. Like, you can plug in additional variables, but at the end of the day, how fast you grow dictated your valuation. So the faster you grow, the higher your valuation, the quicker you can do. Get to an IPO.
And the valuation was based around, as far as I understand, it was a multiple of revenue, broadly.
Exactly. A multiple of revenue, but again, as a function of your growth rate. Yeah. If you continue to grow, that will put another dimension to your valuation. Now, there are different ways to do valuations, and I'm not an expert. I'm not a VC or investor expert, but that's basically it. That's what we need to understand. Now, because the public sector is telling us that we need to become profitable, that's also part of that. Now, will the VC model work under that? Because as you alluded to, sometimes becoming profitable means that you cannot spend on acquisition, on acquiring new customers as much as you would like to, or you can if you had this more money in the bank, right? So you need to sometimes grow slower, however, in a more sustainable way.
Exactly. And you can't grow at a rate whereby in year one, you lose a ton of money on the hope that in year 2 and 3, you'll recoup that money and it will become profitable. Because your churn will be too high. And again, I know there's lots of factors when you look at valuations for companies, but managing churn is really important. So a lot of companies are a lot of clients are very concerned that if the supply base supplying into them starts to grow too fast, then they take their eye off the ball of their existing customers. Therefore, service quality goes down, and therefore the client goes, "I'm going to drop you, and I'm going to pick up someone else instead." And so you get this increased churn effect because there's too much growth on the supplier. And that again can be a problem.
It's a classical problem that we see, that companies focus too much on acquisition, focus too much on that new logo, that almost every dollar spent is focused on the sales team and maybe the marketing team, not enough on the customer success and the people that are responsible to retain and expand the existing client base. So maniacally focus on acquisition, not focusing on new customers. And that leads a certain mindset, right? So we compensate the sellers on numbers. And in a lot of cases, it means I'm going to sell to whoever wants to talk to me. Whether is the right customer for us, is the right product for the customer, and we'll be able to retain them after the first contract expires. So that's kind of the mindset that needs to change, for us to look into more of a sustainable growth strategy.
So if you kind of follow on from that kind of macro picture about what's going on, then how can SaaS and tech firms improve sales productivity? What do you think is the route to sales productivity? First of all, what do you mean by sales productivity? And then what's the route to get there?
Yeah, before we talk about productivity, let's focus on efficiency, because that's the first thing, right? Let's focus on efficiency. And efficiency is basically how do we get more dollars from every dollar spent?
Yeah.
Right? And let's connect that to our previous comment. Can we focus and can we get more revenue from our existing customers?
Yeah.
And that sometimes means that, instead of hiring more salespeople, we need to hire more customer success people that will serve our customers, that will make sure that they're getting the impact and the value from our products. Can we be more proactive in identifying expansion opportunities? So this is probably the first thing that we need to look into. The second thing is, going back to what we believe, scientific and data-driven decisions. Can we analyze and understand where or what is if I put in a dollar, we call it on the acquisition side or the customer success, the retention expansion side. Yeah. If I put a dollar here and a dollar there, what will be the outcome? And this is where we start to model different options.
Yeah.
And so that's the first thing. Second thing is, as you said, try to look and improve. If we are looking at the acquisition side, what are the sales process? What are the areas that we can improve? So you gave the example of selling to outside. We call it selling outside of the ICP, ideal customer profile. Yeah. Can we improve that? Can we redefine what is the ideal customer profile? Because with one segment, they're not retaining enough. We're spending a lot. There's a comment, let's go into enterprise because we want to close bigger deals, right? So we hear it a lot from companies. And it sounds great because bigger deals, bigger companies, higher ACVs.
It sounds great from someone as a SaaS company who hasn't done it before.
Exactly, right?
Trying to move from the mid-market into the enterprise market as an ICP, as you well know, that's a very difficult road to tread and requires, I think, relevant to this conversation, the biggest issue is time. It will take you 12 months minimum, 3 years probably at the extremes, to sell into those enterprise clients.
I agree. That's a fantastic point, but I would love to add things. If people also don't consider how much resources these customers suck from you.
Absolutely.
Because you're selling to a Fortune 500 company. Yeah. They're your biggest account. They know that.
Exactly.
And they say, hey, this feature, we want that.
Yeah.
We want that API connectivity. And then your product people are spending all their resources. Instead of following the roadmap, they need to spend all their time on developing that for just one customer.
So this is very interesting. I think if you look at a SaaS, again, I'm not a SaaS expert by a long chalk, but you look at the SaaS model, and obviously it's about, to an extent, standardization. Every customer has broadly the same kind of features. Some are turned on, some are turned off, but it's broadly the same kind of system. However, if you go into the enterprise space, you end up building 10 different businesses because everyone is very different. So now you've got a SaaS company that's serving the enterprise market, but it's no longer SaaS. It's got this SaaS mid-market offering, and then this enterprise, complex, bespoke, different instances model. That's a difficult model to build and to run profitably.
Fantastic example. I haven't thought about it in that way, and yeah, it's a fantastic point.
And therefore you end up with, then you get conflict at a leadership level about, well, where's the profit? Well, the profit's going to be in the enterprise market eventually because they're bigger deals. Right, okay. But our business isn't set up for the enterprise market. It's set up for the mid-market business. So how do we transition? Do we create two businesses? It all gets much more complex, I would say.
Yeah, I agree.
And you can start to move away from core purpose if you're not careful.
Yeah. So we talked about efficiency. That's just one example. There are many other points along that strategy and processes, go-to-market processes that we can do in order to improve our efficiency as an organization and thereby becoming scalable or sustainable.
So if there's a revenue leader that's listening to the podcast, and let's say they're doing 100 million of revenue and they're a SaaS company, so ARR is 100 million. So they're a decent size, but they need to get to 300 million. But they've got this kind of problem of, I can't hit the accelerator pedal too hard because it'll drive down profitability. And we're now being asked to drive profitability. What would your advice be to that kind of revenue leader to go from 100 to 300 million? What are the kind of the big things they need to be thinking about?
So first of all, you need to, and that's true for every company that is in that transition period, make sure that you have the right data model. The right data model meaning, let's make sure that you have the right data to be able to make those decisions. At this point, we want to start, we probably already have a scalable operation because usually you say like from that 10 million to 20 to 100, you're in that scale up mode. So you have already a system in place and then you need to start just scaling that, right? And scaling usually means at that point, at that level, create more processes, hire more people and have those people execute based on that process. At that 100 million to 300 range, you're focusing on not profitability, you're on the way to profitability, but productivity. Can we get the same using less resources or getting more using the current resources that we have? And in this case, you're trying to see whether you can reduce costs. Now everybody's talking about AI. That's going to be, I haven't seen any game-changing products right now, but everybody's talking about, let's create an SDR agent. Let's create an agent that will be able to save us in our prospecting or will allow us to do things automatically or AI and will reduce the amount of time that everybody's doing. So I think this is the future there.
I mean, what's interesting, Roee, on that point, I think, is if you look at, again, I've just been reading some reports about, it was 675 client interviews. And there was a research report that was produced. I've forgotten the reference to it. I've just been reading it. But some of the things that were coming out of that were they want more personalization. You know, clients don't want mass customization using AI. They know what's going on and they're not interested. Something like 90% don't respond to cold outreach.
Yeah.
Something like, I think 25% only were looking at LinkedIn on a regular basis because they're busy people.
Yeah.
And when they're differentiating and they're looking at, differentiating as in, who do I pick as a supplier to work with? Well, you need to have deep insights and you need to be a sector expert.
Yeah.
And you need to be a thought leader and you need to have solved this problem before. You need to be the trusted advisor. Remember the old trusted advisor model that was developed in the 1980s, 90s? We're going back to that trusted advisor model. I don't think it ever went away, certainly not in the enterprise world, but it's certainly becoming more prominent, I would say.
That's right.
And SaaS companies, I don't think, are used to that. They're not used to being the trusted advisor, I don't think. Consultancy companies are. The big five are. That's what they lived on.
Yeah.
How SaaS companies are going to make that transition, if they need to, I think will be interesting.
It also reminds me of an important point. When in 2020, 2021, and in the years before that, when everybody was buying and everybody was experimenting and
money was plenty of money around. Yeah, money was cheap. Exactly.
Our sellers didn't need to know how to sell. You probably had to have a decent product.
Yep.
And just go out and say, I'm not saying it was easy, but a lot of companies succeeded and a lot of sellers succeeded without really needing to have those good sales skills, as you just mentioned, like the especially when selling to enterprise, becoming that trusted advisor. Hey, I just say cyber and security, and the enterprise will follow because that was a hot topic, or still is a hot topic nowadays, right? But becoming that trusted advisor, and as you said, probably people will continue to buy from people.
Yep.
That is something that there's sellers that learned how to sell in the past 5-7 years still need to upskill their sales capabilities.
Absolutely. And it can take up to, between 12 and 36 months before an enterprise will buy from you.
Yeah.
So what we might be seeing is if they're going to start to all go into the enterprise market, you're going to see this dip whilst they build relationships and therefore the sales flatten. And if they haven't got their retention right, then they're going to start to lose clients on that journey. So the market may well change again. I think it's very interesting that they're looking at, obviously the enterprise market's very attractive, but it is very difficult to sell into. I've sold into enterprises for many years. They're very, very, very tricky.
Mm-hmm.
It can consume all your time and not be profitable. But they're good long-term clients.
Yeah, they are. And usually multi-year kind of contracts.
Multi-year contracts and big deals. But big deals take a long time to land. Why? Because people like me in my old role in procurement, we think about risk. Well, any time we bring on a new supplier, that injects risk.
Yeah.
And if that new supplier is a SaaS company and it's going to be embedded into the heart of our systems environment, I'm going to be concerned about, what does your balance sheet look like and what's your growth path and what kind of clients are you going after? And, are you going to get there in time? Are you going to run out of cash? All those things are on my mind because once we engage with you and we start working with you, unpicking all that's pretty difficult.
Yeah, that's right.
So salespeople have to have patience and they have to be professional, high-end, enterprise-type salespeople that can engage with the C-suite. That's not an easy skill to gain at all.
Which comes back to another point that I wanted to make at what a company needs to focus on between that 100 million to 300 million. And that 100 million usually might happen even earlier, but you start to look at additional, we call them go-to-market motions. And different either segments, such as going into enterprise, or different products, or different regions. This is where you start growing your total addressable market in order to be able to find that $300 million. This is like the next level. So we talked about just one example going into different segments. So from mid-market going into enterprise, it could be the other way around. It could be introducing a new product to your existing customers or to a new market. And that's also how you probably would find growth and going from that 100 million to 300 million. And we also see this is a fantastic time for M&As. So companies that are at that 100 million ARR, if they do have enough cash, they will buy other companies, maybe struggling companies that have a fantastic product or an initial customer base, and they would buy them for that IP or for that customer base. So that's another kind of leverage and focus for these companies at these areas.
So, Roee, I'm conscious of your time. We're at the kind of about 30-minute mark. Just kind of in summary, what are your kind of like top 3 kind of thoughts for SaaS tech companies as they start to think about profitable sales growth?
Is the market really changing, or is just one of those cycles that, things are calming down, but as soon as money will be available, then we will go back to our old bad habits? That's the first one. Second one is AI. We alluded to, we talked about this briefly, but that's going to do another complete change of our industry. And one of the outcomes that is related to AI, but not necessarily only because of AI, is the pricing model. Going from let's do a subscription model into consumption model. And that's also going to change the way we interact, sell, and engage with our customers. So I think these 3 are good topics to look out for.
So interesting, on that last point before we close, subscription versus consumption models. Do you think there is a bit of a shift going on?
Yes.
And why is that?
Again, there's a lot. I don't know. Still, it's a good question. There's a hype right now. There's a lot of buzz, a lot of conversation. I don't know if there's a shift.
Right.
I heard and talking to our customers, they are considering that to a certain extent. I think this is driven by AI. And again, Salesforce 3 or 4 weeks ago, Mark Benioff introduced their moving away from, at least in their AI agents, moving away from subscription-based into a consumption-based. I think Salesforce, as they did throughout the last 15 years, they are driving and they are the first trailblazers in the market. And I think this is definitely a trend that's picking up.
Interesting. Need to look out for that. Brilliant. Roee, it's been fantastic. Thank you ever so much. Where can people find out more about you?
LinkedIn's the best channel.
Very good. Excellent. Thank you for joining us. It's been a real pleasure.
Thank you for having me.
Thanks for listening to Higgle, the B2B Sales Club podcast series with your host, Mike Lander. Please subscribe so that you'll catch all the next episodes.